There we go. Well, welcome to week 7, which is a continuation of the theme around investing. And we're going to have a bit of an introduction to index investing this week. So without further ado, let's crack on. I do need to give you the standard disclaimers again, just so this isn't financial advice of any type whatsoever. This is just stuff I've learned and that I'm sharing with you. At the end of the day, it's your decision. You need to do your own research and you need to be happy with what you are doing. Just because some stuff has worked so far for me, it does not necessarily mean it will work in the future. As they say, what happens in the past is no guarantee for what will happen in the future. Although if we follow the sort of standard structures, it's looking probable that it will carry on in the way it has. One very important thing to note as well is investments can and indeed will go down in value as well as up, which is very important. So a quick recap on what we did last time. We had a look at what are assets. Basically, assets are things that produce an income. So stuff that brings you money, okay? And then we had a look at what are stocks, shares, and equities. Essentially, three words for the same thing. They are you owning a bit of a company. Now, very important also to know when not to invest. Okay, so when aren't you going to invest? Don't invest if you need the money. The markets can move up and down pretty quickly, so you could easily have less than what you put in if you need the money in the short term. So there we go. That's pretty much that short-term stuff. If you think you will panic when the market goes down, also not a good idea to put money into investments, because if you sell out when the market goes down, yes, you make a loss. Okay, you need to be able to bear with it. So this also goes along with risk averseness. So if you're not up for a bit of risk, again, investing is probably not where you really want to be heading with your money. And again, risk averseness, feeling a bit unsettled about things, don't invest. You need to do things which you are happy with, which will make you money in a way that you are comfortable with. Okay, and also you need to have done those previous steps to getting wealthy. So they are your emergency fund, paying off your debts, and having 3 to 6 months living expenses sort of sitting to one side. Okay, that paying off debt is ever so important, because there is not an index fund in the world which has performed at a rate better than general credit card debts and that sort of stuff. Credit card debts are usually 15% plus in the interest they charge you. On average, over a long time period, an index fund will probably generate you 10% a year. So yeah, please do not take out debt to do investing. And if you have debt, pay it off before you start investing. So I'm going to see if this will work. It's a little extract from Gerald Collins' Simple Path to Wealth interview with the Playing with Fire guys. So hopefully it will. If you can hear it, please give me a thumbs up, Vanya, because you're the only one with your camera on at the moment. Okay, so I'm relying on you there.
The research is conclusive that index funds are the most powerful way to build wealth in the stock market. If you understand what an index fund does, if you take, for instance, the S&P 500 index fund, which is perhaps the most common and the most popular, or the total stock market index fund, BTSAX, which I personally have a slight preference for. The idea is the index fund buys every stock in the index. It doesn't try to guess which companies or which stocks are going to outperform or underperform. And that's what works best. But it's counterintuitive, because you think back, and this is incidentally the thing that kept me away from index funds for a decade while I sorted this out in my head, unfortunately. But it just seems that it'd be so easy to choose which companies are going to do better, or to just not buy the dogs, and by definition you would outperform the index. But the research is absolutely clear that doesn't happen. And I think the reason it doesn't happen, as I speculate about it, is that today's dogs are tomorrow's exciting turnaround stories. And today's high flyers are sometimes the ones that we're then reading have crashed and burned. Building the portfolio, if you're following my simple path to wealth, building the portfolio is the soul of simplicity, because you really only need two funds. You need VTSAX, which is the total stock market index fund, and that's for building your wealth. And when the time comes, you might want to add the total bond market index fund, which is VBTLX. So those are the only two you need. It gets a little more complex because we have these things called 401ks and 403b plans and TPS plans if you work for the government. And they may or may not offer these kinds.
Okay, so that was a quick overview with JL, the man himself, as to different types of sort of investments that you can do, but an overview really of what an index fund is, so that you can kind of see it owns a little bit of everything. And we covered that mostly last week. Oh, so let's skip on to the end of that and we can move on to the next one. Oh, now, how do we get out of there? Come on. There we go. Right. Most important thing is don't try to make up for lost time, or don't try and skip ahead. I mean, that's what JL was kind of saying, in that, you know, trying to pick stocks to accelerate your earnings, even if you are really, really good at doing it, chances are you're going to make a mistake at some point. So unless you really know what you're doing with investing, I would definitely not try and do that. And as an example, this is what I currently hold in my ISA. Now, the only ones in there that you can see in the bottom right hand corner, which are currently green over the last 2 years, are all Vanguard tracker funds. Okay, pretty much everything else is down. You can see at the top there my awesome pick there, that's down 94.5%. So in order for that to make back to where I'd invested, it needs to gain by 1,000%. Okay, so that one's pretty much wiped out, and that's what can happen with stock picking. So my advice is don't do that. Stick with the tracker funds, and, or sorry, rather, not my advice, but what I would do if I was doing it again would be to stick with the tracker funds, which, as you can see, over the last, I think this is 3 years, have performed much better. As I say, that's my ISA. Fortunately, my pension, I was much more sensible, because that's where most of my money is. And as you can see, that I put into predominantly Vanguard funds. I thought I'd try 3 different Vanguard funds and see how they performed against each other. And as you can see, all of them are sitting in the green. So I don't know, the proof is in the pudding. You can see the mistakes that I've made there through trying to stock pick. Please don't make the same mistakes. So yes, there is no such thing as a sure thing, but the Vanguard trackers are pretty good. I mean, other companies do offer trackers. Don't get me wrong. They offer pretty similar trackers to the ones that Vanguard have. So if you have a pension provider which doesn't give you access to the Vanguard funds, if you can find a FTSE Global All Cap tracker or equivalent, then that is like the Vanguard Vanguard FTSE Global All Cap fund. So you will find very similar things under different names, but it's very important to still check the facts document that comes with it. And Alan and Katie did do a video on how to check the different documentation that comes with the different funds. But why Vanguard? Well, essentially, because Vanguard does not have shareholders, they are not beholden to anybody apart from the people who have their money with them. So they can have low fees, they can use index funds, and they can focus very much on keeping the whole process as simple as possible. In the UK and the US and a few other countries, they do offer their own platform for doing savings and investing. And to be honest, I probably should have gone with that so that I was limited just to the Vanguard funds, because you can only get Vanguard funds on the Vanguard platform. However, I went with a different platform, which platforms, funds, and all those sorts of things I will explain next time. So just bear with me on this one for now. But basically, Vanguard have tried to create the most simple, basic, low-cost way to invest your money. And as we saw last week, the difference that fees make over your investments, it is well worth finding the platform with the lowest fees. Regards time horizons, and this is also quite important, is that if you only have your money in the market for a year, you've got an over 30% chance of losing money. This is why, if you've got a house deposit that you're going to spend and that you're going to want to spend in the next 12 to 18 months, it's not a good idea to put it into an investment, because there's a good chance that it would lose money. Over 5 years, that drops to 15%, 10 years down to 10%, and over 20 years, there hasn't been a single time over the last, I think it's about a century and a half or so, that a 20-year time span has actually lost money having it in the markets, looking at something like the S&P. So let's look at the S&P, for example. You can see here, it had a period of relatively slow growth. So, I mean, if we draw some lines on here, we can see that, well, let's pick out where you would have lost. If you had bought here, then, hold on, let's keep that on there. Then you can see if you'd have bought there, you'd have had to wait until sort of around here again before making your money back. So that's a sort of, I think that was the longest, that was the 20-year time span. But if we look at from the start, then you've got a sort of a gradual growth plan there, which has, over that span of time there, which I think is about 60 years. So, if you take a normal working period, that is it. But then if we look at the up to the current time, we suddenly see that we've got this much steeper growth curve, and you can even take a steeper one if you started investing from the middle of the recession. But you can see there that even though the markets go up and down, and they've gone down quite a bit in this gap here, if you've got the ability to hold, if you've got the ability to wait, then they have come up again. But it is all about patience. It is all about waiting. It is all about getting in as early as possible and having time in the market. So that's what it's all about there. So how you lose money is by panicking when there's a crash and selling. Just keep hopping in and out of the market. So buying some and then selling it, and buying it and selling it. That's a very good way to lose money. And I've done that as well. Learned from that one. And then also trying to time the market, trying to guess when it's going to be at its lowest so that you can buy low and sell high. Okay, some people can do that, but the average Joe off the street, not a good thing to try and do. The other way that you can certainly reduce, if not eliminate, any gains that you make is to choose a fund that's got high fees. So just be aware of what is going to happen. Be aware that, the markets are going to drop, and actually reframe that from a position of, oh no, the market's dropped, I've lost some of my investments, to, maybe now's a good time to get a few more because, the stocks are on sale, essentially. So you only, as it says here, the only time you've actually lost money is if you have to sell. You've still got the same number of stocks and shares on paper. So if you sell when it's lower than what you paid for them, then yes, you have lost money. So you need to always have in your head, have I got a good emergency fund to get me through 6, 12 months, so that I don't have to take money out of my investments? Or do you have, you know, something that you can fall back on just to earn a little bit of money to then pay the running costs and the bills for a few months? Listen to JL's meditation. If you need to find it, if you simply go to YouTube and do JL Collins meditation or meditation for when the market drops, you will find his meditation, and you can just listen to his lovely calming voice for half an hour. And I think you'll probably be asleep by the end of it, so you won't actually be able to do any selling of any. A crash is over 20% drop. We had that last year. It will happen. It happens on average every 8 years or so. So just be aware that it happens. It is inevitable because the market sort of overheats itself as such, and you just need to stick with it and ride it out and wait for it to come back up again. And if you've got a tracker fund, that is inevitable. If you've stock picked individual stocks and shares, it can go down and it can go to zero, and you can lose very easily. So here's a little example of some of the major crashes that they had in the past. As you can see, in every instance, it's come back up again. The Black Tuesday one was one of the biggest crashes, and that was an 86% drop. But if you look at the dates on these, the drops are becoming less and less severe generally, and the recovery period is becoming shorter and shorter. So that's kind of good news for us as investors, because it means that the growth again afterwards is happening quite quickly. So if there's a crash, they're on sale. Now, something else to think about is the difference between lump sum investing and what's called dollar cost averaging. Now, lump sum investing is where you literally take a lump sum of money and just shove it straight in. So literally that would be, I don't know, you get an inheritance and then immediately chuck it all in. Or what would be really nice is if you won some money off a radio show or something, and chances are they'll when you're on the phone, they'll say to you, oh, what are you going to do with this money that you've won? Are you going to go on a holiday? Are you going to buy a hot tub? Are you going to buy a new car or a new television or something? They'll be quite surprised when you say, I'm going to invest it in an index fund. Buy my freedom. That would certainly crack open a conversation or two, I think. But lump sum investing statistically will give you a better return than dollar costing into buying in approximately 75% of situations. So just chucking it all in, time in the market, get it in there and do it, which is what I've done. Having said that, at the same time as having put a lump sum in, I am every month adding in some extra. Now, putting in something every month or every week or, you know, every period that you can afford to, that's called dollar cost averaging. So that's literally every time you get some income. So you get your wages at the weekend or month end, pay yourself first. Before you've done anything else, obviously you've worked out your budget, so you know how much money you have got spare. Pay yourself first, put some into your savings, put some into your investments so that you've got it there. And if you can, set up a direct debit so it just goes out every so often when it's required. And that is dollar cost averaging. So you buy all the way through. So let's see how dollar cost averaging works on sticking it into the market or trying to time the market. Here's a little example for you. So we've got three ladies here: Terrible Tiffany, Brilliant Brittany, and Steady Sarah. So they all have $200, pounds, whatever you like, each month to invest. Now, Tiffany is always going to buy at the high point of the market. So Tiffany and Brittany are going to time the market. Tiffany is, as I say, she's going to manage to pick the top of the market every time, stick her money in there, and then it's going to drop. Brittany, on the other hand, is going to perfectly pick the bottom of the market. So when the stocks are at their lowest, she's going to buy, or the index is at its lowest, she's going to buy the index, and then the rest of the time she's going to put the money into a savings account waiting to find another bottom. So that's what Tiffany and Brittany are going to do. Sarah, she's not going to worry about it. She's not going to try and complicate things. She's not going to try and time the market. She is just going to steadily put in 200 a month, every month, over a period of, say, 41 years. So this is based on doing it between 1979 and 2020. So how does that all work out? Let's take a look. Well, so here we go. We had Black Tuesday when the market dropped 33%. So we're going to say that Tiffany put in just before it dropped. Brittany, on the other hand, bought at the bottom of that drop. Then we had the Q8 war, the dot-com crash, financial crisis, and the COVID crash. So those are the points when Tiffany and Brittany have put their money in. Okay. And between those times, they've just kept it in a 3% savings account. Let's see how they did. Right. So the answer is, oh, look, Tiffany ended up with about 773,000. Brittany ended up with 1.1 million, and Sarah ended up with 1.6 million, roughly, over that period. So just putting the money in steadily and having that time in the market just outperforms trying to actually time the market as to when you're going to put the money in. So either stick in a lump sum and then keep adding as you can, or if you are not mentally comfortable with just putting in a whole big lump sum, then yeah, just every month stick some in, something like that. That's what I would do. So here we go. The homework for this week is have a week off to reflect over everything that we've spoken about. Have a thought about your feelings, your personal feelings about how risk averse or otherwise you are. Would you be willing just to put in a whole lump sum, or would you want to sort of dollar cost average, as they say, and put in some every month? And ideally, you know, set up a direct debit. Now we'll have a look at the funds and the providers and all that sort of stuff in the next call, which is the when is the next call? The next call is the 20th. So we will have a look at that sort of stuff then, or you can go away and do some of your own research, which is great. The other thing which is highly advisable is to watch J.L. Collins's full talk on, which was done by Google, and you can see it on that YouTube link there, or you can scan the QR code and you can go and have a look at that. So there we go then, folks. Don't be a sheeple. Don't follow the crowd. Don't just chain yourself to a desk for 60, 70, 80 years, however long it's going to end up being. Take control of your finances. Take control of your future. Buy your freedom. And yeah, be extraordinary. Okie dokie. So I am going to stop the recording.